Hey everybody, Colby the DGI Crab here, and I've got a question from a viewer that I'm going to go over here today. And that viewer's question was simple, and that is, why do I prefer Vanguard's Dividend Appreciation Fund, VIG, over DGRO, the iShares, I'm going to call it the equivalent of VIG. I'm not offering direct financial advice. I'm not a licensed professional. You should always do your own due diligence before you invest in anything. But I thought it would be worth comparing these two ETFs so you know why I personally prefer VIG to DGRO. I do think that they're both really nice options. They are both ETFs that are included in my 8 ETF Great ETF Race series, which I hope that you're all familiar with by now, that I do every other Tuesday. Uh, Fine investments. Both of them have their advantages. VIG, for me, comes out just a little bit on top. So I thought we would just sort of go through this, and I can explain to you in more detail why that is. So if you're new to the channel, the thesis is that the age and time horizon of the investor is the most important metric that they should take into consideration. I typically cover 60 high quality dividend growth stocks, but my personal investment strategy has me putting at least 50% of new investment dollars every week into ETFs for automatic diversification. Now, of those 60 stocks, I split them into 4 separate categories or tiers based on the age of the investor. Tier 1 being the younger folks from 18 to 30, Tier 4, the older folks, 54 and up, and then VIG, DGRO, those come into play kind of in tier 1, but for me more so in tier 2 for the 31 to 41-year-old investor, where VIG is the ETF that I invest in the most. I put 25% of new money every week into VIG. Now, this could say VIG slash DGRO. By the way, for tier 1, I still think it's a good idea to start a position in a dividend appreciation fund, but just at a 5% weighting. Now, like I said, it could be VIG slash DGRO. They do have a lot of similarities to them, but I want to break down the two and just kind of compare them side by side. So we're going to go here to Seeking Alpha. I'm going to start here on VIG. We're going to take a look at the holdings in VIG initially here. So you can see our top 10 holdings. We've got Apple, Broadcom, JP Morgan, Microsoft, United Health, Exxon, Visa, MasterCard, Costco, and Home Depot. So let's see. Most of these, I believe 7 out of 10, are in my 60 dividend growth stock category. Apple's not, just because they don't grow their dividend fast enough. Otherwise, they probably would be. Let's see here. MasterCard is not, and it's nothing against MasterCard, but it was just picking between Visa and MasterCard, and I went with Visa. MasterCard's great as well. And then Costco's not in there yet, but it's definitely on my watch list. I still wanted to build up a little bit more history, but that's a great stock as well. I love this group of top 10 stocks. There's a total of 341 stocks in the ETF as of this recording, and the top 10 make up 30.76% of said ETF. If we look at the expenses of VIG, the expense ratio on this one is very low at just 0.06%. And then the dividends that it pays out, you can see here as of today, it has a starting yield of 1.74%, has a 5-year growth rate of just above 10%, and a dividend growth streak of 10 consecutive years. So the yield is a little bit on the lower end for me for a tier 2 investor. I typically want for the individual stocks that I purchase to be yielding mid to high 2%, if not a little bit better than that, depending on the type of deal that we are getting when we buy it at the time. But this 5-year growth rate of 10% is absolutely fantastic. Double-digit dividend growth rate. If we think about the rule of 72, where we take 10%, we add on this 11.74%, we're just shy of a 12% dividend compound factor here. 12 goes into 72 6 times, so that means that I believe that my dividends will double every 6 years with this ETF. So for 31 to 41, I've still got multiple 6-year time periods for those dividends to double and compound and reinvest. So I really like those numbers there. Now, if we look at DGRO, the iShares Core Dividend Growth ETF. We're going to take a look at their holdings as well. Top 10, Broadcom, JP Morgan, Apple, Microsoft, Exxon, Chevron, J&J, AbbVie, Home Depot, Procter & Gamble. Now this one, we've got 9 out of 10 of these are in my 60 dividend growth stock category, everything but Apple. And again, Apple's a fantastic stock. I just wish they'd grow their dividend a little bit faster because it's a very low yielding stock and it's also pretty low growth on that dividend. DGRO has 418 individual holdings, and this top 10 makes up 27.34% of the ETF. Checking the expense ratio, ever so slightly higher than VIG, not significantly though. 0.08% is the expense ratio there, so a little bit higher, but pretty insignificant amount. And then if we look at the dividend tab here, DGRO is going to start out with a higher yield, 2.27%, so about 50 basis points higher, give or take. And they also have a 10-year consecutive dividend growth streak, but the 5-year growth rate on this one is 8.28%. So if we, again, add these two numbers together, we're getting about a 10.5% dividend growth compound factor with the starting yield and the 5-year growth. Whereas with VIG, adding the current yield and the 5-year growth rate together, we're getting 12. So this one may only double about every 7 years as opposed to every 6, which that extra year can make a big difference if we're talking about a couple of decades worth of time for the yield to grow and compound. But then finally, what I want to do now to summarize here is take a look at the price appreciation in addition. So if we look at VIG, we can see over the past year, it's grown 14.2% in share price. On the 5-year, we're going to call that 58%, 57.96. We'll just call that 58%. And on the 10-year, 138% share price growth. If we compare that to DGRO, and we look at the same metrics here, on the 1 year, we're getting 12.66% compared to 14. On the 5-year, we're getting 45.7 compared to 58%. And on the 10-year, we're getting 126% as opposed to 138. So VIG is going to give you a bit lower of a starting yield in comparison, but all of the other growth metrics are beating DGRO, from share price appreciation to the rapidity of the dividend growth. Both of these ETFs, as I said at the beginning, are excellent options, and if you are just really invested into DGRO and you really believe in that one over VIG, absolutely, I will not turn my nose up at you if you come up with, some other reasons as to why you would prefer DGRO over VIG. But for me, I think that the winner between the two is pretty clear. So that's why VIG is the ETF that I'm focusing on the most here in my final year of being a Tier 2 investor. And I would like to know what you all think. Which one do you like better? I know that there are other ones as well, like SCHD, VYM, etc. But these two have fairly similar strategies in terms of the yield and growth combination. But I do think that VIG just wins in too many metrics, whether it be share price appreciation, slightly lower expense ratio, slightly better dividend growth rate, even though the starting yield's a little bit lower, especially if you're in your early to mid 30s as opposed to early 40s like me. Starting yield shouldn't be a major consideration for you in terms of trying to chase really high yield. You want to get the stuff that still grows at a really nice rapid clip. And I like the idea of having an ETF like VIG that's going to give me a good solid 10% on average annual dividend growth year over year over year. So that way, even if some of my individual stock predictions turn out to not be so hot and they don't grow as much as I am projecting them to grow, I think VIG is a pretty safe bet to do just that. Send me any questions that you have, like this particular viewer did, to dgicrab@yahoo.com. I will always respond to your email with an email, but if you have a question that deserves a little bit of a longer form answer like this, with your permission, I will do a video on the subject so we can all learn together and become better dividend growth investors as a group here. Thank you so much for watching. Check out the links in the video description below, including a link to my ETFs by age video, where I break down exactly how I invest in ETFs depending on my age and time horizon. Catch y'all in the next one.